All right, thank you for tuning in. I see the participant count rising. We'll give it just 1 minute. All right, thank you everyone for tuning in today to another edition of our weekly Strategic Insight Live. This one is 2H 2020, Shaping Your Recovery in the Second Half. So for this one, we will have an introduction by David on what we can look to for a macroeconomic outlook. And then I'll come back to see you in the second half and talk about specific strategic things you should consider about shaping the second half of the year and how your assets, your balance sheet, and you can recover. I'm going to bring David back now to start his presentation. If you have any questions while we're going through our presentations, please use the Q&A box down below and ask them. We will have time for questions at the end today.
Excellent. Thank you, Teresa. Hopefully you all can hear me and see me. I want to give you a little bit of an overview over the next 30 minutes about where I think we are now. There's our disclaimer, now that you've read that. I'll get an updated version of this presentation. Some of these slides, if you've seen these presentations that we've done them a couple of times now during this whole experience. Some of these will look familiar, but that's because it's really important, I think, in experiences like this to have a framework and then to adjust the variables inside the framework. So the framework that we established early on and shared with y'all over a month ago now was really appropriate, I think, for the crisis that we're, again, experiencing. And so what we're going to do is we're just going to update what's going on inside the frame. But overall, I think much of what we've predicted to this point has come true. So hopefully that record holds, and what we say today will also be useful for you. Just to refresh your memory, we've had pandemics in the past, and therefore we do have history that we can draw upon. Not going to take you through each one of these in detail, but what this chart shows you is a timeline on the bottom, and then each of these pandemics, the Spanish flu, the Asian flu, the Hong Kong flu, and then the swine flu, ranked by their deaths on the left-hand side. And the Spanish flu was particularly awful. Remember, that was back during World War I. We didn't have an antidote. We didn't have a vaccine. And ultimately, there were 50 million people worldwide who died, and 675,000 people who died in the United States of America. I do not think this is the Spanish flu. In 1957, we had the Asian flu. It killed, 1 million people worldwide and 100,000 here. Then we had an echo version of that in 1968 with the Hong Kong flu. And then, although nobody remembers it, we had a particularly nasty flu back in 2009 that ended up infecting 60 million Americans, but had a very low fatality rate. So you may not remember the swine flu, but that was a pandemic. It just happened pre-Twitter, right? Now we've got the Twitter flu more than anything. All right, in terms of the best analog for this, and you may recall this from before, I still think the Asian flu of 1957, 1958 makes the best comparative for where we are today. During that experience, we did have a recession. Obviously, it did worry the nation. We actually did go into quarantines. We did self-isolation. There was a bear market that accompanied it as well. And ultimately, it caused 1.1 million deaths worldwide. There were 65 million cases in the US, and our population was much lower then. Obviously, the way the CDC estimates these case counts is in hindsight, and that's a very interesting development in terms of what's going on right now. We have these tracking polls that you're seeing every day. Cuomo came on yesterday and said, we've seen evidence that maybe the contraction rate in New York is more like 15 to 20%. If that's the case, then 65 million Americans could get the coronavirus, if not have already had it. So this is a good analog, I think. In terms of the death rate, it was about 0.2%. 116,000 Americans died of the Asian flu. And you can see it did have a pulse higher, lower, and then higher, but ultimately it only lasted about 9 months. And we did develop a vaccine. It was only about 50–60% effective, but it did restore confidence, and that's what's mission critical to the economy. All right, so back during that period, just to familiarize you with it again, the Dow did decline as the death fatality rate climbed about 20%, 21%. It says 18% here because I've included dividends. But through the entire episode, from February of 57 to September of 58, the market actually climbed over that period. And here's why. I've updated these numbers. You may remember this chart. This is quarter over quarter. It's important as all these GDP statistics are being tossed around to understand what you're being fed. So the quarter over quarter rate takes the rate of change quarter over quarter and annualizes it. That gives you a much bigger number, okay? So if you go back to 57, 58, the first quarter of 58 was the quarter where the social isolation really occurred, and that took quarter over quarter annualized GDP down about 10%. That's a really big number, actually, for one single quarter. And one of the first times that since the Great Depression, we saw a decline in consumer activity, again, as a result of that isolation. But then you can see things recovered rather quickly and also robustly. And so you go out a couple of quarters and the economy was really growing like wildfire, 9%, 7.79, and then leveled off a little bit again. So if you go through third quarter of 57 to third quarter of 59, that 24-month period, the economy actually grew 6% over that period. And if you do annualized GDP, which is the way that the government typically quotes it, we really only shed about 3%. So instead of being 100% of the pre-Asian flu economy, we got down to about 97%, but then recovered quickly and ended up growing into 1959. So this is the best analog we have for where we are today. Let's say how these two charts fare in the coronavirus. The drawdown that we had in the Dow Jones Industrial Average right after the case counts really started to climb in the US was the most severe, quickest, fastest drawdown. And then a little bit after we had the last call that we did live like this one, we saw the fastest recovery. We went down 40% basically in the Dow in a very quick period of time. And then we recovered, call it 33% in the Dow. And now we've sort of flatlined, as this chart shows you, in the midpoint of the range, which is good because we're digesting those rapid gains and trying to get a sense fundamentally of where we are today. So right now we're down about 20% year to date on the Dow, or from the top, I should say. But the max drawdown was 40%, which was very, very significant and a great opportunity, which is why we pulled our hedges down there. In terms of the GDP projections, I'm using data from Morgan Stanley here. Again, when you listen to the media, it'll tell you there's going to be a huge drawdown this quarter in GDP. That is absolutely true. What they sort of hesitate to tell you is that next quarter could be the mirror image, which is also potentially true. So if you look at the GDP growth rate over the entire time period using the same kind of framework as we did on the previous slide, because of the higher than average growth rate coming out of this, we could see a recovery in GDP and also growth. But the drawdown in the second quarter, which we're in, is a 30% drawdown. It's pretty nasty, and really around 8% of total GDP. So multiples of what we saw in 57, 58, because those isolations were voluntary and they were very patchy around the country. There were some schools open, some schools closed. In this scenario where we're all connected by the interweb, everybody's just shut down here, there, sort of everywhere, overseas as well. And so that's created sort of a multiplier effect on what we saw in the GDP drawdown. One thing that does give me a little bit of optimism, and you know me to be somewhat optimistic anyway, but the sectors of the economy that have come offline, travel and leisure, hospitality, quick serve food. These areas of the economy can be reconstructed rather quickly. Those employees can be brought back on in short order. It's not like you're shutting down the entire manufacturing sector of the US and some sort of depression-like economic drawdown, and you've got to figure out how to reinvigorate, retool, and turn all of that back on. So the estimates, of course, are that this is going to be a very slow recovery, and I think it'll take a little while to start catching momentum. But structurally, we can move pretty quickly in terms of bringing people back out of unemployment into the workforce. And if we have the confidence to go re-engage as economic actors, then things could happen more quickly, I think, than sort of base case consensus. Nonetheless, we are going to have a big, fat, ugly recession this quarter. It's sort of a flash depression in my head, but then there's opportunity to recover quickly afterwards. All right. The markets have said, absolutely, we've got a recession. So I'll update this for you. The average drawdown in the stock market is 34% in recessionary periods. And we, again, fell 38%. So we definitely checked that box. I see a lot of tweets and a lot of concern around this is going to get so much worse. Economically, this is a structural problem. It'll be like the declines in 2007, 2008. It'll be like the declines in the Great Depression. So let's test that thesis a little bit. Not all market drawdowns are the same, okay? This is good work that Goldman Sachs did. And they basically said you can classify market drawdowns into one of three categories: structural, cyclical, and event-driven. Structural drawdowns are like the Great Depression. Okay, and in the Great Depression, there was no insurance behind the banking system. So if a bank failed, the deposits just went away, which created a run on the bank, which created a suck of liquidity out of the marketplace. The government didn't know what to do. We were basically a developed nation at the time, and that exacerbated and extended the Great Depression because we didn't have any policy tools really to combat it. And then we had a structural decline. Obviously, we were over-levered in 2007, 2008. There were all the ninja mortgage loans. That was a problem. The banking system, froze. The Fed sort of figured it out, but it took them a little while. That was a structural drawdown. And on average, structural drawdowns end up being like 50, 60% lower. Okay, so those are bad. Cyclical drawdowns occur when the Fed gets nervous, the inflation's riding high, they think it could get out of control, and they raise interest rates to sort of intentionally put the economy into recession to, sequester any inflation risks. And so cyclical drawdowns happen frequently. They end up being about 29% top to bottom. And so cyclicals happen. They're not as severe as structurals. And then thirdly, you have the event-driven drawdowns, which end up being about 29% as well. They accompany exogenous events, such as the crash in '87, which was terrible. By the way, the market ended up the year higher. The Russian currency default maybe in '98 would be an example. 9/11 would be an example. And so there are periods where we don't really have a cyclical reason for the economy to recess. We don't have any structural problems, but we have something exogenous that just knocks the wind out of the market. That's the event-driven type. Now, in terms of average recoveries, this is important. So on average, it takes 60 months, call it 5 years, for markets to come back after severe bear markets like what we're witnessing. Well, that's average. For structural bear markets, it takes 111 months. I mean, it takes 9 years. For cyclical ones, it takes, almost 60 months. For event-driven, it actually takes less than 2 years, and really it's about 1.5 years on average. So event-driven markets can be sharp drawdowns, but also tend to recover a whole lot more swiftly than structural bear markets or cyclical bear markets. Now, we weren't really due for a cyclical rollover. Yes, the stock market, the economy had been growing for a long period of time, but it hadn't been growing very swiftly. And we didn't, from a structural standpoint, have a whole lot of bubbles that required popping. The system wasn't over-levered. Yes, there was a lot of corporate debt, but at very low interest rate levels. So when you look at the actual debt service ratios, they weren't stretched. So we didn't really have a cyclical reason to go into recession. We didn't really have a structural problem in the economy. So therefore, I really think this is just an event-driven drawdown. That being the case, the recovery should be historically somewhat swift. All right, update on the 3 crises. If you remember, crisis. If you remember, there were 3 things that we were worried about when this started. 1, were we going to have a financial crisis? That would be bad. Number 2, was there going to be an economic crisis? Was this recession going to get out of control? And then 3, clearly, we have a healthcare crisis. So to get through this, we've got to inoculate against 3 viruses. 1, financial crisis virus, 2, economic crisis virus, and 3, obviously, the coronavirus. Well, on the first one, if you look at the financial crisis, we're not going to have one. The Fed has done tremendous work. Obviously, they learned in the Great Depression. That helped them in the Great Financial Crisis. That helped in this period. And they've acted more swiftly, more boldly, and more robustly than they ever have before. And the bankers I talk to, they say, look, we're flush with cash. We're happy to lend if people can meet the criteria. Obviously, the PPP loans are flying out the door. So we do not have a shortage of money supply. We do not have a shortage of credit. There are no sort of risk symbols showing up in money markets or commercial paper. And so the financial system is fine. You know, obviously we need a robust financial system to have a robust economic system. We are not going to have a financial crisis. So on the left, as you know, they cut interest rates to 0. And on the right, the amount of quantitative easing they pumped into the system is just extraordinary. Now, will there be unintended consequences of this later on? Perhaps. And so for those of you who are worried about inflation, it's not showing up yet in the data. It could show up later, and that may be something to be nervous about. But with oil prices at 0 a barrel, you don't really worry about that. Unemployment has caused wage rates to come down. Energy rates have come down. And so if you look at the inflation expectations grids, they're very benign. All right, in terms of the economic crisis, think about it just at a high level. The US economy runs along at about 20 trillion in GDP. If you're going to lose, call it 3 trillion to the coronavirus, and I'm just using that as a number, then you've got to fill that gap, right? You've got to either recover to that gap or you got to fill it. This is where the governments step in, right? This is where fiscal stimulus steps in. They step in as the consumers and the businesses step out to try and maintain level in the economy. This is the pace by which the government stepped in to repair what happened to the economy during the Great Financial Crisis. So on the bottom, 0 days to your left, 600 days to your right. It basically took 600 days from the inception of the financial crisis to get 2 trillion of stimulus into the system. And the financial crisis started when 3 hedge funds blew up inside of BNP Paribas. So it was sort of a butterfly effect that cascaded. Nonetheless, we saw our first stimulus bill about 200 days in, and our last one 600 days in. In this experience, we've gotten, and this needs updating, by the way, because they passed 484 billion more yesterday, and there's discussion about another bill, which would really be a stimulus bill. This is seen as a relief bill. So that number can go up, 2x from there, who knows, right? But the first death from the coronavirus was reported in China on January 11th. Within 100 days, we blew out the deficit to 15% of GDP. It'll probably go to 20% of GDP. And we passed historic legislation to fill the gap in the economy. Now, again, the economy runs at about 1.5 trillion a month. So if you fill 3 trillion, you're basically subsidizing 2 months entirely of the US economy. So from a macro perspective, from a GDP perspective, they're really going to level things out with the size of these stimulus programs. Now, below the waterline, there's chaos as small businesses, fight for resources and try and figure things out. But above the waterline, the GDP rate, because of the amount of stimulus the government's put in the system, should be somewhat level, which is crazy, but true. In terms of the healthcare crisis, I've done these numbers for you before. They haven't really changed. Just to go through them, typically in the flu season, the world will see 700 million cases with 650,000 fatalities. In the US, we see anywhere from 40 to 60. Pre-coronavirus, the estimates were that this was going to be kind of a nasty year for the flu anyway. And so they had predicted we see 60,000 fatalities because of the flu, 60 million might get it. And so the US fatality rate for standard flu is about 0.1%. I'm sure you've seen these numbers before. Where are we with COVID? These numbers are a little bit dated, but still close. So 2.3 million cases, I think, worldwide. 2.8 now. I've got some updated numbers. 2.8 million. There have been 194,000 fatalities. In the US, testing is accelerating. We've got 850,000 cases, 47,000 fatalities. And what makes everybody nervous is this fatality rate of 5.36%. But remember, if what Cuomo said is true, then 20% of the population in New York has had it. In California, they're seeing similar sort of results, trying to figure out the true number of cases out there. Those have come back, 10x, whatever the case. That would drive our fatality rate back down to below 0.5% overall, which is more realistic. And as those estimates grow, that number will fall. So in my own estimate, which I shared with you all over a month ago, I just said, let's just use the Asian flu as a proxy, 0.2 kind of fatality rate. And if we do socially isolate, then maybe we can drive our contraction rate down. And if that's the case, maybe 40 million of us have this, and then the fatalities would be around 70,000 or so. If you take the fatality rate up to that 0.5%, then you get closer to, 125,000 or so. So pretty severe, but right in line with what we saw during the Asian flu. And actually our population was half the number back then. So how do we avoid this? Well, obviously we're in quarantine, we're social isolating, we're doing that now. This was a little dispiriting yesterday. Remdesivir, which seemed to be the lead candidate as an antiviral, there was a report out of China that it really wasn't all that effective. Whether that's believable or not real sure. It was sort of leaked. But that knocked 300 points out of the Dow yesterday, because at this point in the market, we're all sort of praying that the scientists come through. There was a report last night that the Brits have stumbled on something that's effective. So there are so many people working on this, and there's a profit motive and incentive. So I feel confident we'll see an antiviral, but we don't have one yet. In terms of vaccine, obviously Moderna has gotten a lot of support with their mRNA, and most predict that we'll see something within 12 months. The good news is the healthcare system is working. So if you look at daily new confirmed COVID deaths, they are on the decline. It appears that the world sort of peaked in terms of fatalities around April 16th. So this is something to watch. But as we get into the summer, the expectation is the humidity, the heat will disturb the spread of the disease a little bit. And obviously the scientists can catch up and help inoculate us against it. So we're not quite there yet, but we are making progress. I've been asked for a timeline of when we reopen and what some of the milestones could be. I ripped this off from Morgan Stanley, but I don't really disagree with any of their points. I may have shared this in last week's email, so I'll take you through it. The expectations are that U.S. new cases will peak about now, and they have. It looks like we're already rolling over. The antiviral trial results, Gilead has not produced their own measures on the effectiveness of remdesivir, but there are lots of things in trial right now. So we should get some encouraging information, I would hope, later this month. And then in terms of testing capacity, I think I saw we're past the 500,000. So at the end of May, we should be able to test 1 million people a day. That would obviously be good. Serology testing widely available. I know some people who've been tested for it. Somebody told me on Poplar Avenue here in Memphis, there's a clinic where you can go get tested to see if you've already had the coronavirus. And so the more people that get tested, find out they had it and that they've survived and feel fine, the more confidence we'll rebuild in the economy. And that's necessary to get everybody back to work. Now, some areas, I guess if you're in a tattoo parlor in Georgia, you can go back to work. Some areas have already gone back to work, and we're a little bit behind Europe. Obviously, Germany's doing a staged opening. South Korea's done a staged opening. China, 70% of their restaurants are back open. You know, the factories are back. And so those that were first in are first out, and they are making progress. Wave 2 returns to work. Not even sure what that really means, but I'm really excited about this. Schools reopen. So it's important to me, probably important to all of you all, that those kids get back to school. And then I've been asked a lot about a potential second wave of infections. That does occur. People point back to the Spanish flu. I think that's irrelevant. Again, we had no science, we had no antibodies, we had no antivirals. There could be a second flare up, but we've got short attention spans. And if we get confident that we can survive this thing, then maybe that becomes a little bit more of an irritant like the standard flu rather than being the catastrophe that COVID has ended up being. And especially if we're near term on a vaccine. And the estimates are, again, that we'd see one maybe first quarter of next year. All right, in terms of what this recovery is going to look like, I want to dispel any notion that this is the Great Depression 2.0. So that's the point of this slide. The optimistic case is that the scientists catch up and confidence resumes and we go right back to being the people we were prior to the coronavirus, which eventually we will be. There'll be changes. We'll probably do more Zoom calls, et cetera, unless we all get Zoom fatigue, which is possible. But my guess is, this is maybe 55% likely. And then you've got a U-shaped scenario, which, by the way, just says you're going to have the same amount of drawdown. It's just going to take a while for people to go back to Disneyland. And so, yes, you'll have a recovery, but your pace will be slower. So both the V-shaped and the U-shaped scenarios estimate that we take GDP down 7-8% year over year, which would correlate with that 30 to 40% within the quarter. But then you'll see some sort of recovery. Okay, just for comparison, that's the Great Depression. We're not going to have a Great Depression. The Great Depression commentary is off base. It was a different time. We had a different set of regulatory principles, and we didn't have the amount of stimulus capability at the Fed or even within Congress to do what they've done. So we are not going to go into a Great Depression. So here's the bottom line, and I'm going to hand it to Teresa, and I'm almost there, Teresa. In 1957, we had an Asian flu. The globe sacrificed, or the flu unfortunately claimed 1 million souls. That would equate to about 2 million today. We did have a bear market. The Dow price-wise went down 21%. There was a hard stop recession due to social isolation. That happened in the first quarter of 1958, but the market bottomed prior to that in the fourth quarter of 1957. In terms of where we are today, the global population is twice as big. As I said, if the ratios approximate the same, there'll be 2 million people that we lose to this across the globe. We have absolutely hit that bear market. We were down 38% at the low on the Dow. There will be a hard stop recession. We're in the middle of it right now. Maybe a 30%, 40% drawdown to GDP quarter over quarter, which again would equate to a 7 or 8% drawdown year over year. And that would, to be analogous with history, presume that the market bottomed in the first quarter of 2020. I do think that's the case. How are we doing on the global inoculations? Well, remember, we are not going to have a financial crisis. Fed did everything they needed to do with interest rates. They're pumping unlimited funds into the system on the quantitative easing side. So I give us a check mark there. We are inoculated against a financial crisis. In terms of the economic crisis, I can't give us a full check mark because we're not through it. But I will say that what the government has done is tremendous and at multiples of what other governments around the planet have done. So the US has definitely been on the job, both in the White House, Congress, and the Fed. I do think that'll inoculate us from the economic crisis, but until we clear up the health crisis, we can't give that the all clear. I do think we're making progress there, so I'm giving us a half check at this point. But we really need the science to catch up now with the antivirals, with the serology testing, and then obviously, ultimately, with a vaccine. In terms of V-shaped returns, I get a lot of questions, like I said, about is it a V, is it a W, is it an L, is it an I? You know, the market only moves in V's, right? The market doesn't do U's, the market doesn't do L's, it only does V's, downs and ups, downs and ups. And so if we go back and we look at history, in 1957, large stocks were down 11%, small stocks were down 15%, and look what happened in 1958. Large stocks were up 43, small stocks were up 65. This was as 2 days ago. Large stocks down 10.5%, 11% in the US, small stocks down about 30%. Where are we going to be in 2021? I don't know, but if history is at all at play in repetition here, then we should have a pretty positive year, and I imagine we would. We've certainly had dramatic gains already off the lows. So I think, and I think I wrote this in this past email, we've really reached the halfway point. We've seen the case counts peak. We've seen the fatality rates peak. You know, that ship that they put in the harbor in New York has moved on. You know, New York is actually exporting respirators at this point. So the health crisis is still with us, but it's diminishing. I think the stock market's got it correct, which is that we're in a little bit of stasis waiting for the science to catch up. But once the science reinvigorates consumer confidence, people will come out of their houses. I actually went to Home Depot today, and there was a long line in a full parking lot. And yes, I wore a mask. Yes, I socially distanced. I did all the things you were supposed to do. But there were still a lot of people there. So the economy is not at zero. People are starting to venture out again. So I do think we've reached the halfway point. The question is, from here, how do you position yourself to prepare for the recovery, to profit from the recovery? And for that, Teresa, I'm a little bit delayed by 3 minutes, but I'll hand the microphone over to you.
Thank you, David. I also need your screen. All right. Thank you for doing that. That was very, very thorough. I think you by far have the heaviest lift going through all of the things that we cannot control. I get to deliver some good news on this Friday afternoon, which is there still are things we can control. So I'd love to talk to you all about those today and how you can shape your recovery in the second half of 2020. But first, I must talk about our team of wealth strategists at Waddell & Associates. What I will present to you today is the direct result of our collaborative efforts at the end of each business day. We come together and talk about everything we have learned through this pandemic crisis, and also ways in which we're finding opportunities through the chaos. So thank you to all the familiar faces on the screen, David included, for the effort, the work, and sharing. One of the things I love to say about W&A, and one of the reasons I love to be on the team, is when a client hires one of us, they're really hiring all of us, because we do share all knowledge with each other and pitch in. So the first thing you can do to shape your recovery in the second half is take a look at whether you had a solid financial team when everything turned upside down. And we really found ourselves in a surreality. Was your banker in the loop with your CPA? Was everybody coordinated with payroll? Hopefully you had a wealth strategist or planner taking the burden from you and coordinating all the details. One thing we see happen often is everybody on the team can be giving awesome advice, but if there's not coordination among all the players on the team, sometimes the advice goes bad. We will get in later to our COVID-19 financial prescriptions, which were again a direct result of our team of wealth strategists coming back together at the end of the day. These are available for download from our website. If you go to www.waddellandassociates.com, there'll be a pop-up where you can go to our COVID-19 portal and you'll be able to download these directly. You can also reach out to your wealth strategist. You can even reach out to me, T. Bailey, at waddellandassociates.com, and I'll get these to you. Oh, there we go. There's our coronavirus portal. Just click right there and it'll take you right to it. All right, before I get into those COVID-19 financial prescriptions, one of the wonderful things that we realized as we came back together every day was that a lot of this is coming back to the basics. Biggest thing, was your emergency fund really enough? There's general rule of thumb, and then there's actually having the funds you needed during this crisis. Rule of thumb for personal emergency funds, 3 to 6 months of living expenses. For businesses, it's more like 3 months to 1 year of retained earnings, either for an emergency or maybe an opportunity. And I do take this one from David. He says it a lot, but I'm going to steal it for this presentation. You have to consider possibilities versus probabilities. Possibility, anything can happen. A pandemic might sometimes fall into the possibility category where it was a little bit hard to think about it, but as David pointed out, it has happened in the past. So really, in a big bowl and a big bucket, consider all of the possibilities that could happen to you or your business, and then begin to carve out what's really a probability and do the math on those, the things that you think are most likely to happen. Then I feel like adding a little bit extra of what I call sleep at night cash is perfectly fine. If the math says you need a certain number, but you know you would sleep better at night with just a little bit more, as long as you're still aligned to meet your goals, I think that's just fine. And then make those adjustments immediately. If you wait to catch up in your bank account before you increase your monthly savings, or what I like to consider your paycheck to your future self, if you wait to make that adjustment, chances are you might kick that can down the road and never adjust it upwards. So do that now. Expenses, mandatory versus discretionary. In this time period, was it easy to identify those discretionary expenses, those expenses that are meant to be able to be carved away in an emergency? Did you have in place the proper expense record keeping, maybe personnel? And did you have a disciplined review process? Are you sitting down, making sure that the entries were correct so that when you need to make quick decisions, you have correct data? And did you act quickly? This is both structural and behavioral. Did you find yourself needing to cut an expense, needing to make a change, but for some reason you weren't able to motivate yourself to do it? One thing I know, I needed to maybe shop a little bit less on the internet and cut my expenses, and I have had a steady stream of packages at my front door. So even financial advisors sometimes can't get over the hurdle to make a behavioral change. All right, legal documents. And I'm going to run through the next ones of these pretty quickly so we don't run out of time and we have time for questions. I imagine there'll be a lot for David. Legal documents. This has been a little bit of the elephant in the room. I know we're all thinking about it. Some of us may not be ready to talk about it. But did you have the proper legal documents in place if you were one of the ones that ended up being in the hospital in the ICU? When did you last review these documents? Did all of the important parties in your life have the powers necessary as well as the access required to act on your behalf? And do they take into account any recent family changes, maybe divorce, remarriage, grandchildren have entered the picture? Now is a good time to go ahead, talk to an attorney. They are doing Zoom calls. I've been on a lot of them lately. And do a review. You may not need to make any changes, but these are the moments where it becomes important and it jumps to the top of the list. So go ahead and take advantage of it being top of mind. And a little side note, this came up the other day. Where are those important documents? When we had this, where we were forced to self-isolate, if those documents were in a lockbox inside the bank and the bank was suddenly drive-through only, or it was closed, you would not possibly have been able to get at those documents. So make sure you know where the copies are. The people who have powers in those documents know where the copies are, and that maybe there's even a digital file of them available. All right, insurance. Quickly, we know sometimes we all pay the insurance premiums for years and years and years, and we never need it, and we wondered if it was a wise use of funds. Wimbledon is no longer wondering if all the years of their pandemic insurance payments were worth it. They are definitely worth it. In addition to knowing the details of your insurance coverage, which we always recommend, you also should be ready to be an advocate for yourself if you believe something should have been covered and you find that it wasn't, or the insurance company is telling you that it wasn't. We see this a lot with health insurance as well. Be ready to be an advocate. A lot of the insurance industry is up in arms that business disruption insurance wasn't paying out under the virus clause. And so a lot of them have stirred up lawsuits. So be ready to be an advocate. All right, quick. I think we all have had the PPP versus EIDL discussion. I'm going to scoot this guy in here now. It's the Main Street, gotta hide my screen, Main Street New Loan Facility. This is really meant for mid-sized businesses, and that's up to 10,000 employees. One thing, it's all over the document on this one, you cannot use it to refinance other debts. So they're really gonna pay attention to that. They want to see these funds used for payroll and employee usage. This loan is $1 million to $25 million. It's an adjustable rate based on the secured overnight financing rate, SOFR, plus 250 to 400 basis points. I'm not yet an expert on this rate or where it stems from, but I plan to be very soon. The term of the loan will be 4 years, but 0% of this one is forgivable. All right, and on to the PPP problems we all know that have arisen. We've gone through many of them. How much can we get? We went through on our last webinar sort of how to calculate that. Now we have this weird 8-week period, and a lot of us are fielding questions right now, and there's still many points where there's lack of clarity. But I did want to outline this today on this call. Funds eligible for forgiveness must be from costs incurred and payments made within an 8-week period that begins the day that you receive the funds. And hopefully you received those funds and they went into a separate bank account. That's very important. They must, in order to achieve forgiveness of the loan you received, 75% of that must be used for payroll costs. 25% can be for non-payroll costs. They still must be allowed payments, rent, business interests. All right, so what if your business is closed, and I made up these dates, until May 18th, right? So you received your funds on April 20th, your business is closed until May 18th, and then the end of your 8-week period is June 15th. All right, you had 0% revenue until May 18th, 50% revenue after May 18th. So what does this mean for your PPP funds? It means you need a PPP strategy that correlates to your business. You'll use those funds to begin to rebuild your workforce before opening. PPP will cover that. You're going to use those funds to stabilize your workforce after your business reopens. PPP is going to pay for that. You'll be at 50% revenue, so you're still not going to have the standard revenue you're used to. You're going to reach the end of your covered period, and you likely will not have spent all of your forgivable loan on payroll. So what does that mean? It means you're going to have some really favorable financing with the leftovers. It's 2-year, 1% money. So you can pay it back, or you can continue to use it for payroll costs after the end of the 8-week period. And it's still a good use of funds. Most importantly, and this is another one that I've stolen from David, run the business, not the benefit. So if you have a choice between trying to maximize revenue for your business, go with those strategies. Trying to maximize forgiveness at this point shouldn't be the #1 most important thing on your mind. All right, on to the COVID-19 financial prescriptions for business. Part of them are the PPP that we just covered and the other loans. Other things to consider. You may also be eligible for a payroll tax credit. These are items to consult with your CPA on. This is one, the payroll tax credit, you probably don't want to qualify for. It means your revenue from 2019 quarter to 2020 quarter, your revenue has dropped by 50%. So it's not a great one, but if that has happened to you, consult with your CPA. You may also be eligible to defer the Social Security portion of the employer part of your payroll taxes. Again, if you're going to take advantage of PPP on either the tax credit or the tax deferral, you will not be eligible for these. You may be before you receive the PPP credits, still a little bit unclear on that. All right, other things to consider if you're trying to recruit right now, you can pay directly for student loans. That's pretty cool. Also, take a look at your net operating loss if you have any. You can now carry those back to 2013, depending on when the operating loss occurred. That's another one to talk with your CPA about. Hopefully, again, you have somebody, a financial planner or a wealth strategist, to help you have these conversations and manage all the details with the other folks that will be involved in these decisions. Moving on to individuals, Roth conversions. The reason that we talk about Roth conversions right now, if you're someone who will pretty much be able to guess what your 2020 income will look like, to be able to give to your CPA and your strategist, is your traditional IRA account value has now dropped. And if you were planning on doing a Roth conversion, now it's even more favorable because you'll be taxed on the account balance you move over. So you'll be able to move over more funds right now and have them appreciate in the Roth. You can also double up on your Roth contributions because the tax filing and IRA contribution deadlines have been moved until July 15th. You can deposit a 2019 Roth contribution today, as well as a 2020 Roth contribution, and get them both invested in the market before the market fully rallies. All right. Oh, tax rebate. Let me jump on this one real quick. If it hasn't landed in your bank account, you either didn't qualify or you're going to have to do a little digging. It was based on a bank account you used to file your last tax return. And if they sent you a letter, it was sent to the address you last filed. If you didn't file with the IRS, a change of address form. So if you didn't receive it, again, you either didn't qualify or the bank account or mailing address was old on your last tax return. If you didn't qualify for 2019 numbers on your tax return and your income drops and you could qualify this year, you'll receive that on your taxes next year when you file for 2020. All right, tax prescription. You can give more to charity, even if you don't itemize. The first 300 you'll still get credit for. They've also adjusted up the adjusted gross income limitation for your charitable contributions up to 100% for 2020. So that's great news for the nonprofits and charities that really also need the money right now. And for harvesting tax losses and reinvesting simultaneously, I think this is a great point to bring David back on to talk a little bit about investments right now.
Thanks, Teresa. Good stuff. There's just some general rules of thumb that make sense for right now. And we've obviously been working with clients on this and making some of these decisions discretionary basis on their behalf. But number one, most importantly, asset allocation matters, right? When we run the financial planning scenarios, and it dictates out whether you should be 60-40 stocks, bonds, 70-30, stocks, bonds. Those asset allocation analyses, they anticipate drawdowns in the market like this, right? So the most important thing during these types of periods is to stay true to that asset allocation. And the other thing that's good about asset allocations is if the stock market goes down 30% and the bond market goes up 5%, well, now you're out of balance. You need to rebalance, and that gives you an opportunity to sell high and buy low. So we've been doing a lot of asset allocation work and rebalancing on your behalf. That should be the warm blanket in periods like this. You've got an asset allocation because you worked with a strategist, hopefully at WNA. And if you did, then you are correctly positioned for a drawdown like this. Secondly, how do you make lemonades out of lemons? Well, in your taxable accounts, if you have losses, you harvest them. We have designed the portfolio such that we can tax efficiently move out of one security into one that's very similar in ETF land, thereby being able to harvest tax losses. And we've harvested lots of tax losses. So if you have accounts outside of WNA and you've got tax losses and you can sell positions and buy into similar positions, then do that because that ends up improving your after-tax returns over time. I get calls periodically about flyers. Should we chase oil? Should we chase, Bitcoin? I'll get sort of calls on that. At the fringes, it's okay to have a play account as long as it works within the context of your financial plan. The one thing I will caution people against, and it's behavioral finance. In our business, our customers, our clients, our family members are long-term investors, okay? And I know you hear that a lot, but it's really important. the way that we've calibrated our entire system is to be successful over market cycles, long periods of time. The people that are playing the market on a daily basis mostly are computers, but for those that are actually individuals trading, they by nature are traders, okay? So their whole framework is around trading. Our whole framework is around investing. When you switch from an investor to a trader, you're operating in a field that's sort of not the usual game, and often when you do that, you lose. So that you can be successful periodically as a trader, but if you're going to be a trader, that has to be the discipline. That has to be the investment discipline. It's hard to be both an investor and a trader. And I don't see opportunities every once in a while. You know, we could buy palladium at a discount or blah, blah, blah. But moving money in and out of those things is a trade, not an investment. We are really long-term investors. What we're trying to do is compound money over time. So for those who are considering buying into this distress, I would argue to do it just broadly. You know, make sure you got large caps and small caps. I like internationals, as you know, because it adds geographic diversity as well, emerging markets. I don't think you have to get cute to make money. With that, we've got about 10 minutes left over. I don't know if we have questions in the queue.
We do. Okay, David, if you could only look at one indicator to gauge where we are, what would it be?
My desert island indicator. That does change over time. If you remember this time last year, my desert island indicator was the economic leading index, because I was fearful that we might be slipping towards recession. It tipped negative briefly. We ended up hedging. That was useful, but you got to know which indicator is right for the right time. So right now, the one that I watch religiously all day long, drumroll please, is the small cap index. And here's why. Back in the financial crisis, obviously the banking system was in duress. That was a financial crisis. This crisis we're having is a small business crisis. Can they have access to credit? What happens to the loans that are already out there? Obviously, the bond markets required governmental support. They don't have the resources of an Apple or an Amazon. By the way, Amazon's up 30% year to date. So this forest fire is good for the tall trees. It's bad for the short trees. So for instance, in a week like this, I think the S&P closed flat this week. Small cap index was up about 3%. That warms my soul. So my single indicator for this period of time is the small cap index, because this is a small cap crisis. And as that index shows recovery, it means there's real fundamental recovery in the economy. So my desert island indicator right now would be the small cap equity index.
I see a slide coming, desert island indicators. David, have you seen a financial recovery in other countries rebounding from the COVID-19? And if so, any relationship with what might be expected here?
Yeah, I think I had a chart on this either last week or the week before. The best economy to look at is China. Now, it's not fair because China runs like a corporation, and we are a democracy. And so we can't run with their precision, and we can't run with their speed because, you know, we've got freedom in the way. But their retail sector has come back significantly to 70 to 80% of pre-crisis levels. 80% of the restaurants are back open. Now they're only seeing 70%, I think, of the customers they saw in the past, and they've got social distancing, depends on where you are. But they are coming back online, and that's important to them. And I wrote about this, I think, about a month ago. Remember, they're hoping that by the end of the year, they can celebrate that they doubled their GDP within the last decade. And so they want to see that GDP growth. They're pushing it. And so it'll be interesting, and you got to sort of, you know, take some of their data with a grain of salt. But if they don't see a big acceleration in case counts, then that would be a harbinger of the fact that we could reopen our economy if we're careful and still, you know, reduce the spread of the virus. So China is the best place to me to look at what's going on. Now the data, you know, you have to look at an array of data to get a real good depiction. Remember, Europe's about a month ahead of us. And so Germany is back open. They are taking steps, Volkswagen's coming back online, et cetera. So they're making automobiles again. So we are seeing people successfully come back online. So we're not in the dark here. We can look at China first. We can look at South Korea. We can look at Germany. And they are coming back online. They are spooling up. I think the bottom of the economic crisis is right now. And things are getting better.
And we have one about at what rate do you expect to see the reopening of businesses and economy, which I think you've covered. Do you have any additional to say about the rate?
I mean, let's just pray that the kids go to summer camp. I really want that. And that would happen in June. So fingers crossed. But it's a confidence game if we get an antiviral. The one thing I'm a little concerned about is all the litigation risk. I think people are starting to get nervous about that. There was a big article about that in the Wall Street Journal today. What if you act too quickly? Does that expose you financially to a sort of a tort process? So I think people are going to be somewhat cautious in terms of reopening, but most of the consumer-facing businesses are local businesses, small businesses. I mean, there are 5.8 million small businesses out there. And to be honest, I mean, we're all in this together. I mean, I'd love to be able to support, my friends in the restaurant business in the neighborhood, and will as soon as I can. So I think that things can move a little more quickly, but it is a confidence game. So if we get really good test results on an antiviral, it's going to happen fast. If we don't get any positive test results on anything, and the serology tests are late and testing's late, and there are privacy concerns around tracking people that have the virus, then that could delay everything. But I think that's the under. I would take the over bet, which is that the scientists come through, confidence resumes, and within a month and a half, we're back out without our masks on, without standing 6 feet apart at the Home Depot.
Okay, I have two more questions. And if you emailed or you typed in a question and we didn't get to you, you'll hear from us by email. I'm not picking favorites. I'm going in the order that they came in. Okay, David, if I didn't sell in Q1 and subsequently missed the bottom, is now a good time to double down on favorite stocks and index funds? David says the market does V's, not W's, so it seems the answer is yes.
I think the answer is yes. It's a question of, we get so myopic during these periods. I mean, what's Twitter say right now? But if we just sort of, all right, we've gone through a recession, which is great. We needed one anyway. I'd rather have it quickly than have it happen slowly. So we sort of checked that box. So guess what? It's a whole new cycle. Okay. As soon as we pivot and come back up, it's a whole new cycle. Guess what didn't participate at all in the last cycle? International didn't really participate. Emerging markets didn't participate. Value didn't participate. Traditionally, at the start of a cycle, those actually do well. So it's a great opportunity. It may look like, the Dow's only down 13% right now, but the small cap index is still down 30%. In fact, if you take the S&P 500, which is down 13, I think, and you equally weight the 500 stocks within there, instead of just Amazon and Google and Netflix and Facebook and Microsoft, the equal weight index is down 22%. Okay, so the market has recovered off its bottoms, but there's still plenty of discounting going on in there because there is somewhat, healthy doubt and skepticism that the scientists will come through, that the economy will come back, and if not, then it's bad for stocks, specifically the smaller ones. So this market hadn't really run away from you yet. You can still put money to work.
Okay, last and final. David, I feel like this is now a game show. David, what was the unemployment rate during the 1957 flu? The number of unemployed in the United States now is something that I am having trouble wrapping my mind around. Thank you. Not a fun topic.
Oh, I have that number. I don't think I can toggle. If you give me that, I'll get to the specific math. But right now, we should be around 20% as an unemployment figure, which is terrifying. Remember, a lot of those are retail, restaurants, art and entertainment, things that we can repopulate pretty quickly. And I think if you go back to the 1957, I'm going to get this wrong, but I think we got up to about 8%. But I'll get you the exact figure I have.
I have those things. All right, that's all we have time for. We will follow up with everybody that had a question. Thank you so much for emailing them in and also asking live. It's been, this is the first time we've answered questions live in our little Q&A box in quite some time. So thank you for submitting those. There will be a replay if you didn't catch the beginning part, or if you would like to forward this on to a friend. Visit our website, WaddellAndAssociates.com, again, to that COVID portal. David, any closing remarks you'd like to say?
No, I'm really encouraged, having looked back to prepare for this presentation, to the first one we did in early March, really, and then the second one we did just in the middle of the melee. I think it was March 20th, somewhere around there. We have come a long way, and it feels good to be over the tipping point. I know it's still strange, but be patient. We're getting through it. We're going to be okay. Obviously, take precautions, but financially, economically, we're going to come through this. And then we'll have, plenty of time to debate the merits of all the government spending and who's going to win the election. Oh, by the way, there's an election in November. So we'll have plenty of time to do all that. The good news is I do think we're on the back half of this experience. And there's been a lot of, positive things that have come from it, as well as a bunch of negatives. So I'm encouraged to be able to give this speech and look back at the previous ones and say things have gotten better. And that's it. So thank you. And we'll send out a replay. Feel free to review it and email any questions that we weren't able to address. With that, have a great weekend.